Nitin Rakesh, the CEO, as well as Manish Duggar, the CFO, join us on the show now. Hi, gentlemen. Good morning. Thanks so much for making time and speaking with us. Nitin, let me begin by asking you, what's been your read-through from the quarter gone by about the incremental demand environment that we have been witnessing? Did the quarter pan out the way you expected?
I think we are very pleased with the fact that we ended the year on a note where we've not only come back to growth, but our biggest two businesses, BFS and TMT, are actually leading the growth. So I think given the overall environment, in the industry outlook, I think this is probably one of the better numbers that we've delivered. Especially with the backdrop of the still uncertain macro that we are working with. So a lot of this is driven through everything we talked about in the last few quarters. The focus on in-account actions, extreme amount of focus on investing in relevant tech solutions, infusing a lot of tech and AI into these solutions to actually create a differentiation. So it sets us up very nicely for the end of the year, and of course as we enter into FY25. So very pleased with what we've delivered. I think some uptick in revenue conversion from TCV that was kind of lagging behind, so that helps. Also seen some uptick in shorter duration, short burst deals. That's kind of an very early indicator of discretionary spend pattern. I think again very early to call it. Green shoots definitely visible. So overall quite intense few quarters, but very pleased with where we ended up with Q4.
Right. Manish, a slight miss on the margins as well. Walk us through what the tailwinds are and what the headwinds are at play.
We had called out last quarter that with the impact of the acquisition on a like-to-like basis, what we reported as 14.9% was actually 16%, which was an expansion of 0.5% over the previous quarter. And we had said that some bit of that actually is one time. And, we were expecting the margins to be between 14.6 and 14.9 this quarter. We ended up at, top end of it. And I would expect this to be, better than what the expectation was. Like we have been able to do for Blink over a 2-year period, we recovered the full impact of the acquisition. We expect that impact to be recovered for Silverline as well. I think the metric that actually reflects that is the EBITDA number. And if you look at EBITDA, we were at 18% last quarter and 17.9% the quarter before, and we ended up at 18.7% this quarter. I would say that we actually delivered better than expectation on margin. And while we were not getting the benefit of all the one-times that we got last quarter, we still were able to, using operating leverage and the revenue growth, able to deliver on the top line.
Manish, what about the guidance for the new year, the FY25, and also a margin visibility there?
Absolutely. And our guidance to the community is we should be in the range of 14.6% to 16% on a reported basis, which on a like-to-like basis will be 15.7 to 17.1. And that is compared to the 15.25 to 16.25% range that we had last year, which indicates that we have an outward bias. And within this range also, our expectation is we should be, moving, if not to the top end, to the middle of the range very soon, as we are able to get operating leverage and as we are able to make sure that some of these impact of acquisitions get neutralized.
Okay, so clearly looking for that operating leverage to come by. But talking about operating leverage, Nitin, after that 4% decline that we saw in FY24, which is clearly a challenging year for you, what kind of growth are you envisaging in FY25? Could it be high single digit or at least low double digits?
Yeah, I think the way to think about it is we actually called for, from a guidance standpoint, we have called for the fact that FY25 will be a growth year. And we do expect to deliver better than above market growth. So that really means on a relative basis, if the broad NASSCOM growth ends up being in low to mid single digits, then we should definitely grow faster than that. It's hard to pin a number because we typically don't provide a number guidance for the revenue side. Margin, we give a pretty strong guidance, which Manish just talked about, 14.6 to 16%. I think there is, as I mentioned, green shoots. We've called out bottoming of many businesses in the last couple of quarters. We've seen recovery come back in banking. We've had 2 quarters of sequential growth. So that definitely gives us some confidence going into FY25 about the fact that we should be able to see a decent growth here.
Right. Nitin, deal wins have been quite soft for you. Is it just a timing issue? What's the pipeline looking like?
There are 3 things to think about when it comes to the TCV number. One, we had a massive bunching up in Q1. Now that definitely we're still, consuming a lot of that TCV, and that gives us runway for growth. Also means that, as you convert a bunch of deals, you have to convert the others through various stages of the pipeline, and that action is on. Second, I think TCV is a reflection of the total contract value, but sometimes there may be a 7-year deal, and sometimes there may be a shorter duration deal. What we've seen this quarter is a pretty significant uptick in shorter duration, 0 to 10 million type deals. What that means is these are typically quick burst consumption projects. Early signs are actually we are very happy to see that activity pick up, because that's typically where the discretionary spend pickup happens. You're already working on a project and that gets ramped up, or there is immediate new spend available to be consumed in the next 6, 9, 12 months. That definitely converts, faster than a longer duration 5, 7-year deal. We've seen some of that pick up in this quarter. So given that, ability to consume, on a short-term basis, at least some of these deals, and the fact that we are still consuming the 1.38 billion that we signed in the last 4 quarters, definitely gives us confidence that we should be able to convert that to revenue growth in the short to medium term, next couple of quarters. On a sustainable TCV number, I think the leading indicator always is pipeline. Our pipeline is up about 5% on a quarter-on-quarter basis, which means that a lot of the deals that that we are working on, we obviously have a good chance of getting consummated in the next quarter or 2. So I think we'll be pretty well placed when it comes to signing new TCV and consuming that at the same time.
Right. Nitin, how's the Silverline acquisition scaling up, and any more acquisitions which you have on your radar?
Yeah, I think nothing to call out for, obviously on a forward-looking basis, because typically these are 0-1 deals, but we are still fairly open to continuing to expand capability, and that's been the primary lever for on an acquisition perspective. Coming to Silverline, I think it's still early days. We are still only in the second quarter for as we close that acquisition. One of the biggest theses was to expand our footprint and relationship with the Salesforce, both at a tech platform level and of course also at a go-to-market channel management level. Both of those are progressing really well. I think the synergy pipeline has done really, really well. Synergy wins have been pretty interesting as well, because opens up another market that we were leaving money on the table for. So I think it's the absolute right time to do it, given the focus on AI, especially the massive uplift that Salesforce is seeing in adoption of Einstein and AI and their AI platforms. So I think very, very well placed to capture that over the next 12, 18, 24 months. Integration's pretty much done. Obviously, we've prioritized large deal making and synergy over anything else at this point in time, and that will hopefully play out as we expect over the next 4 quarters.
Okay, well placed to capture growth over the course of next 12 to 18 months. Thanks, Manish, as well as Nitin, for making time and speaking with us today. That's the view coming in from Mphasis after a very challenging FY24 for the company. Seems like they're on the path to recovery, and that's where the stock is holding up.
If you like this video, then like, share and subscribe to ET Now.